Hi guys, welcome back. Andres here. If you are new to this channel, subscribe for more videos. You can subscribe here. In this video, you will learn what is head and shoulders pattern, how to trade the head and shoulders pattern, 3 types of head and shoulders neckline, how to set stop loss and take profit target. So let's start with step 1. What is head and shoulders pattern? Head and shoulders pattern is a typical head and shoulders. It's a kind of chart pattern that consists of 3 highs. The middle one is usually higher than the right and the left one. This pattern is used to work as a reversal pattern if the price succeeds to break its support line, which is called the neckline. Now we have something like this, head and shoulders. This is what the head and shoulders look like. We have the left shoulder here, we have the head, we have the right shoulder, we have the neckline. So this is what head and shoulder look like. Now we have inverse head and shoulder. It's the same thing. It's just that we have it upside down, inverse. So we have left shoulder, we have the head, and we have the right shoulder and the neckline. So we have 2 types of head and shoulder. And mind you, we have 3 types of neckline, which I'll be talking about in this video. The rising neckline, which I call the rising neckline, I call the horizontal neckline, the second one, and the third one I call the falling neckline. So I will be discussing each of these in this video. Step 2 and 3, how to trade the head and shoulders pattern. So many traders find it difficult out there to trade head and shoulders pattern. Now, if you know how to trade head and shoulders pattern, good. But if you struggle to trade head and shoulders pattern, this video is going to give you an insight on how to trade head and shoulders pattern with an edge. So now let's talk about the 3 types of neckline. We have the rising, I title rising neckline, the horizontal neckline, and the falling neckline. So straight to the point, rising neckline. It's like a rising wedge. The price is to the upside. Now we can see this is uptrend. Now the price is creating higher highs to the upside, right? We have the left shoulder, we have the head, we have the right shoulder. What happened here? The price failed to create a higher high. This is a signal, it's a warning that the buyers are weak and the sellers are taking control of the market. So what happened here? We have here a support, right? It's a trend line. So we have 2 support here. The market bouncing on this neckline, which is the support line. Now what happened? Here we can see that this shoulder, the right shoulder and the left shoulder, the both shoulders are above the neckline. So if you have a rising neckline, do not consider this kind of head and shoulder as a high probability head and shoulder. This is the difference between professional traders and traders who are beginners, because it's not just about seeing head and shoulder and you just jump into head and shoulder because it has broken through the neckline and you just want to place your stop and target and trade it. No, you need to know what kind of head and shoulder is going to give you a high probability and what kind of head and shoulder is going to give you a low probability. So you want to trade with low risk and high reward ratio. And this rising neckline is now going to give you low risk and high reward ratio. Why? Because the left and the right shoulder are all above the neckline. So we don't want to trade this kind of head and shoulder. Why? Because this is what happened most of the times. When the price come back to the neckline, the price bounce. It might just break a little bit, but it will bounce, come back, and what you see, the price will just go to the upside and the price will keep ranging in a channel, and it's going to look like this. You will see the price ranging in between a channel. And why? Because we have a low here and we have a higher low here. And the reason is because the both shoulders are above the neckline, and you can see the trend line, which is the neckline. So this kind of head and shoulder is a low probability, and you don't want to jump in even if the neckline is broken, right? So the next one I'll be talking about is the horizontal neckline. And the horizontal neckline looks like this. You have an uptrend, the market is creating higher highs, right? We can see a high here, we can see another high here, which is the left shoulder, we can see another high here, which is the head, and we see another high here, but this is a lower high, right? This high is not higher than this high. Here we can see that this left shoulder is higher than this high, and we can see that the head is higher than the left shoulder, but we can see that the right shoulder is not higher than the head. So what happened here? The buyers are losing control. They couldn't produce a higher high. This is a sign, it's a warning that the buyers are losing control, and now the sellers came in at this point and they're now driving the market down, and they drove the market down to the neckline, right? So we can see that this neckline, looking at this two support, we can see that this neckline is a horizontal neckline, and this kind of neckline will give you a low risk and high reward ratio. And this is the kind of trade you want to be taking, because with this kind of trade, your winning is going to be more than your risk. When the trade goes in your favor, you will make more money. But when the trade goes against you, you will just lose little or half of your target. So this is the kind of head and shoulder you want to consider: the horizontal head and shoulder, or what I can say, the standard head and shoulder. Now, this is what it looks like. When you have a head and shoulder and it breaks through the neckline, always it's normal when the price break through a support, right? This is a support. You see the price coming back upward, testing the neckline. And if the neckline is tested, and at this point there's a lot of sellers at this point, and the buyers at this point couldn't push the market higher, or they could just break a little bit, but if the sellers take control, this is what it's going to look like. You will see that the price will push downward. Why? Because this is a horizontal neckline. Each time you have a horizontal neckline, you are likely to see something like this, and you want to just go in step 3. I will be showing you exactly how you can place your stop, your target, and how you can make money from the market. Now the next thing I'll be talking about is the fallen neckline. Now the fallen neckline is a kind of neckline that you have. If you can see this, the left shoulder and the right shoulder, okay, right? If you put a trend line here, it's the same thing as the horizontal neckline, right? Price is to the upside, price is creating higher highs to this point, right? And at this point, the right shoulder couldn't produce a higher high, giving you a sign, a warning that the buyers are losing control to push the market to the upside. The market is not bullish anymore because the sellers came in and they pushed the market to the downside. And at this point, the market is bouncing on the neckline. Now we have the neckline, but it's falling. It's a fallen neckline. Now the beautiful thing here is because we have a low here and we have a lower low on the neckline. And if we see here, we have a high and we have a lower high. So this is like a double confirmation telling you that after a series of uptrend, market creating higher highs, it came to a point where the market couldn't produce a higher high, and The second confirmation was we have a low and we have a lower low. So this is like a double confirmation telling you after a series of higher high, at this point the market is tending to go down. Now when you have something like this, the next thing you're going to see, if you have a fallen neckline, you are going to be seeing something like this. The market breaks through the neckline, and normally, like I explained before, you will see the market pulling back to the neckline, testing the neckline to see if it's going to break. Sometimes it breaks through the neckline and test it and come back, because at this point, if there are so many traders having just this neckline, having two support, normally there will be sellers at this point waiting to see if this price is going to be rejected at this point. Then the sellers will go into the market, and before you know it, you will see the market going down, going down, going down. Why will the market go down? Because the right shoulder is telling you that since the market couldn't produce a higher high, it's a sign that the bullish market is weak. And now having this point here again, a lower low from the neckline, is another indication to tell you that the market is weak. And now we see again the price pulled back to the neckline here, and the price couldn't really push to the upside, and the sellers took control and the price started falling. So this is a good indication when you have a fallen neckline or you have a horizontal neckline. You want to consider this a low risk and high reward ratio. You want to jump in, but you don't want to jump in when you have a rising neckline. So you want to consider horizontal and fallen neckline as your low risk, high reward ratio. Now we will jump straight to step 3. Step 3, how to set stop loss and take profit target. So many traders out there find it very difficult to set stop loss and take profit target while trading head and shoulder or inverse head and shoulder. And right within this video, I'm going to show you how the professionals trade head and shoulders, where they place their stop, where they place their take profit, and how they make money from the market. So let's go straight. Now here, this is a horizontal neckline, right? Horizontal neckline is one of the neckline that I said is considered to be low risk and high reward ratio. And if you are trading head and shoulder pattern, you want to consider trading it this way. Now step 3, like we talk about, how to set stop loss and take profit target. Now the way to set your stop loss is to measure from your neckline to the head to see how many pips you have. Now if you have, for instance, for example, you have 100 pips here, now you're going to measure from the neckline downward, right? Because your breakout point is here. And normally when the market breaks out, the market tends to push down a little bit and then go back and test the neckline before going down finally. But sometimes it fails. But that is why we have stop loss, so that when the market fails and the market goes against you, you will just lose something, but not much. Just like the professionals do, you just want to take like half of this. If this is 100 pips target, you want to place a stop loss of 50 pips here. So you will have 1:2. So if the market finally goes against you above 50 pips, you will be out of the market. But if the market goes in your favor, right, you will make 100 pips. So that will now define the low risk, high reward ratio. And when you trade in this way, you will always be on the winning side. You will always be on the winning side. Why? Because your losses, you are minimizing your losses and maximizing your profit. You are trading low risk and high reward ratio concept. And this is the edge the professional traders have over beginners. Okay, this is what is making the professional traders be on the winning side, because they have so many losses, but each time they win more. And each time they lose just little amount of pips. So that way they keep themselves on the edge of winning or on the edge of being a professional trader, because what they know and what they're doing, the beginners are not doing it. So if you want to be on the winning side, you just have to do what the professionals are doing. And I'm here trying to tell you guys that it took me time to learn all this, and now that I've learned all this, I am seeing profit in my trading, and I'm sharing this with you guys for free, just for you guys to know how you can be trading with an edge to make money from the market. And if you are not already making money from the market, you just want to follow this video, you want to go by these rules, and I tell you, if you do it right, you will see yourself making profit, and you will see yourself be on the winning side. So this is how you can place your stop, you can place your profit target, and you will make money from head and shoulder, trading head and shoulder chart pattern. And now the next thing we want to talk about is the falling neckline, how to place your stop loss and take profit from the falling neckline, which I also said I consider it to be low risk, high reward ratio. Now going straight to this here, what do? You do the same thing you do on the horizontal neckline. You measure from the neckline right to the head, and you see how many pips. For example, let's use the example of the horizontal neckline. Let's say if this is 100 pips, right, from the neckline to the head. Now we will measure here from the breakout point 100 pips downward to be our target, our profit target. And our stop loss is going to be like 50 pips, which is half of this. So it's going to put us on the low risk and high reward ratio. That way, if the market goes against us, we will lose 50 pips. But if the market goes in our favor, we will make 100 pips profit. And mind you, if you're trading on 4 hours or on a daily time frame, you will have the possibility to cut your losses or to use a trailing stop to trail your profit, so that at the end of the day, while you are in profit, if the market start going back, reversing against you, you will see that your trailing stop is going to take you out, and you have no worries. At the end of the day, you will still make profit from the market. Now the next thing I've talked about how to place your stop on a horizontal neckline, how to place your stop on the falling neckline, stop loss, take profit. Now what do we do next? The next thing I'm going to talk about is the inverse. How do you place your take profit and your stop loss on inverse head and shoulder? So let me take you straight and show you how to do that. Now here, the market is on the downside, right? Market is creating low, 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 low. Now we have series of low, market is on the downside, and at this point on the right shoulder, the market failed to create a low or a lower low below this head. So the market, the sellers here are losing control. They fail to produce another low which is lower than this head, which is a lower low, and now the buyers took control and they push the market to the upside. Now this is an inverse head and shoulder, right? So having an inverse head and shoulder, the way to place your stop and take profit level is just the same thing as the head and shoulder. We talked about that on the head and shoulder here on the head and shoulder horizontal neckline and the head and shoulder falling neckline, and it's the same thing we are talking about right now here on the head and shoulder, inverse head and shoulder. So what you need to do here is to place your mouse here and then drag it and see the number of pips. And let's say, for instance, using the example of pips we used in the horizontal and the fallen neckline, we said, for example, if here is 100 pips, you will measure from this point again, the neckline to the upside, because it's inverse. So now your profit target is going to be to the upside. So you measure 100 pips to the upside, which is going to be your profit target. Now, normally, like we said, if the market break out here from the neckline, it is usually that the market come back and test the neckline. In this case, you can see that the market even broke back to the neckline, test the neckline, broke the neckline, but it came back upward again. And you can see from this example, it's showing from this example that it went back and hit the profit target. And imagine this is 100 pips, like we said, as an example. If you put 50 pips stop loss here, half of your target, most of the times the market will pull back. The market is not going to get to your stop loss because the strength of the market is to the upside, because the sellers here have failed to push the market to create another low. So the buyers are in control, the buyers are in charge of the market. So that is why when you have a low risk and high reward ratio, this is the concept, because you already know that the sellers are not in control, the buyers are in control. And when the buyers are in control, you don't need to put too much of stop loss, you just need to put something moderate. So here, like we said, 50 pips of stop loss, 100 pips of take profit. From this example, if you're trading daily time frame or 4 hours, it depends. The stop loss might not be 100. I'm using 100 here as an example. So your stop loss depends on what time frame you are trading. So this is how to trade head and shoulder, and how to trade inverse head and shoulder, and how to place your stop loss, your take profit level, how to look for low risk, high probability ratio. This is what the professional traders are doing, and this is what is making them to have an edge over beginners. They make money from the market not because they're winning all their trades, but because each time they win, they make more profit, just like this example of 100 pips of target, profit target, and a 50 pips of stop loss. So with this concept, if you're trading like this, you will see even if you lose 3 trades and win 2 trades, you will still be in profit, because if you win 3 trades from this example, it's going to be 300 pips. And if you lose 3 trades, it's going to be 150 pips. So if you have 300 pips of profit minus 150 pips, which is 3 trades, you will see that you will still have 150 pips profit. So this is how the professional traders trade, and they always stay in profit, and they are having this edge over beginners or intermediate traders who don't really know how to trade with an edge. Guys, head and shoulder chart pattern is one of the most powerful chart pattern out there. And if you're not making profit in your trading, try the strategy out and you will see yourself making profit, because if you trade it well, you will see that this chart pattern is a low risk and high reward ratio trading strategy. I wish you guys happy trading. Thank you for watching. Subscribe for more videos.